Hello and welcome to the XFO Intelligence Podcast. Today we're diving deep into a critical topic affecting one of the world's most significant financial hubs, the Superconnector paradox, why Hong Kong's equity market is trapped in a bifurcated liquidity trap, and how to fix it. Now, let's get right to it. Hong Kong has long been celebrated as the indispensable superconnector between global capital and mainland China. But beneath the surface of recent market recoveries and record IPO activity, there's a profound structural vulnerability. The Hong Kong equity market is no longer a unified pricing mechanism. It's caught in a tug-of-war between two incompatible macroeconomic operating systems. While mainland Southbound capital provides a massive volume floor, Western institutional capital still holds disproportionate control over marginal price discovery because of its dominance in the tradable free float. This split perpetuates a persistent valuation discount and magnifies external macroeconomic volatility. Let's break this down. Hong Kong's market is driven by three distinct investor cohorts. 1. Western institutional capital, 600 to 900 billion USD. That's mostly US and European long-only funds, macro hedge funds, and passive index trackers. They may only own around 10% to 15% of total market cap, but they control about 30 to 40% of the tradable free float, and they drive around 40 to 50% of daily turnover. This cohort sets prices. 2. Southbound mainland capital, the primary marginal buyers of daily liquidity, especially in high-dividend SOEs, financials, and telecoms. 3. Strategic global south capital, growing fast, including Middle Eastern sovereign wealth funds and Asian family offices. They anchor the primary market through IPOs, focusing on AI, green energy, and infrastructure. Here's the issue. The capital that provides stability doesn't drive price discovery, and the capital that drives price discovery doesn't provide stability. This has fractured the market into two pricing models. First, the Western pricing model, heavily influenced by U.S. monetary policy, treasury yields, Fed rate cycles, and geopolitical risk premiums on Chinese assets. Second, the Southbound pricing model, based on domestic Chinese credit cycles, industrial policy, and relative dividend yields. One of the clearest signs of this fracture is the persistent premium or discount, where dual-listed companies trade at a 20% to 40% discount in Hong Kong compared to the mainland. This structural conundrum has triggered what we call bimodal liquidity. When U.S. interest rates rise or geopolitical tensions spike, Western capital pulls out of growth stocks, order books thin out, bid-ask spreads widen, and liquidity evaporates, independent of corporate fundamentals. Southbound capital doesn't fill the void because it's focused on yield, not growth. On the flip side, when conditions improve, Western capital rushes in, and with the same thin order books, prices shoot up, creating extreme upside volatility. This wild swing repels the long-term strategic capital that the market needs for stability. So what's the fix? It's not about cyclical optimism. It's about structural interventions. 1. Expand the free float. Regulators and major shareholders can incentivize large buybacks with share cancellation, thickening market depth, and diluting the disproportionate influence of Western capital on pricing. 2. Build structural firewalls. The exchange can create specialized market tiers or liquidity pools for long-term capital, protecting them from high-frequency speculation and macro shocks. 3. Pivot to a global south superconnector. Hong Kong should focus on attracting strategic capital from the Middle East and Southeast Asia, building dual listing frameworks, aligning regulations, and reducing the geopolitical risk premium. In conclusion, the valuation discount in Hong Kong isn't about weak fundamentals. It's about a fragmented liquidity architecture. Hong Kong must rewire its market DNA by expanding the tradable free float, creating tiers for long-term capital, and diversifying its investor base. That's how it can resolve the superconnector paradox and reclaim its status as a truly efficient and globally competitive market. Thanks for listening to the XFO Intelligence Podcast. If you found this insightful, don't forget to like, share, and subscribe to our channel. And we value your feedback. Drop us an email at xfointelligence@gmail.com. Have questions or want more info on our new Thought Leadership on Demand service? Shoot us an email. And now, a quick disclaimer. The content of this podcast is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a professional advisor before making any investment decision.